everyone. Thanks for joining. This is Eric Flegel, and I'm joined by Fred Gratz of U.S. Energy. I'm going to use one of these just because I'm excited. I never get to use this. Fred, thanks for joining.
Definitely.
Oh, actually, there it goes. I got the little, I don't always get to do those. Those are fun. But I like to welcome people to the show the right way. So at the end of the day, we're doing a series, and the whole point of the series is to educate people on some of these tax strategies that we use that I think kind of fall in this latent market. And there's a lot of reasons for that. We'll talk about it, but I really want to hit the main points, which are, why haven't I heard about this before? Is this legitimate? Is this illegal? A lot of times if they haven't heard about it, then they think it's bad. And if it has been around, is this something that people really use, and how effective has it been? So I want to go through those questions. But before I do, I want to legitimize Fred and his company. So I know Fred he's the regional director. I've been working with him myself for the past 4 years. He's been at U.S. Energy for about the last 10. So I want him to tell a little bit about himself, and then I think more importantly, a little bit about U.S. Energy to give you an idea where he's coming from, because I think it's a really powerful place to come from. So with that, Fred.
Thank you, Eric. So again, Fred Gratz with U.S. Energy Development, and we are very much a boutique tax planning firm, right? And at our roots, we're a 40-plus-year-old oil and gas investment firm. We are privately held, have been since day one, and really we're really good at one thing, which is looking at what are those current tax maneuvers, if there's a tax arbitrage, if you will, or a tax strategy, a case planning concept for an investor, and it has to do with the energy sector. We own that content, right? Because basically what we do is we spend a lot of time after decades in this space, and there's a ton of tax law that's unique to the oil and gas sector. So what we do is look at the economics, the assets that make economic sense, even without tax benefits. And then we look at what those tax codes are. And we will literally have a circuitous understanding of the tax code and look at all those permutations and how can investors manipulate that for their benefit, whether it's reducing income tax or gains or other types of tax planning. We try to offer what those tax options are rather than just the default maneuver, which is write the check to the government.
Mm-hmm. So what I want to talk about today specifically is the intangible drilling credit. And I know we're going to do a couple of these different podcasts. So if people see different videos, that's what we're talking about on this one. So can you take me through, Fred, just like high level, what is this? How long has it been around?
Yeah, it's been over a century, 110 plus years at this point that has been part of the tax code. And really what it is the ability in our business, when you're drilling a new asset or completing a new well, you can write off or deduct all of what they call the intangible drilling costs, right? And every sponsor is going to be different, but just think of those costs that are sunk costs, wages and fuel and permits and all of the equipment that's there. You're going to have a lot of that you can write off day one. In our structure, it can be as high as 90% or more in that first year that you can deduct against any kind of income tax.
Gotcha. So again, you said this has been around for over 110 years. So the follow-on question naturally is, well, why hasn't somebody heard of it if it's been around that long?
Yeah, well, a lot of people have, right? The people who do these things. The biggest thing is an access point, right? This is a very small part of the tax code itself, right? We are, and I sometimes joke that it's kind of like the wells that we drill, a few inches wide and a few miles deep. That's the shelf space these things have within the tax code. So in general, I think most people haven't been exposed to it because their advisor or their financial planner that might be part of, say, a larger firm, they don't do these things. And there's a lot of reasons for that, namely the scale of these. There's not hundreds of billions of dollars going into these sectors and these funds. There's a lot less than that. So it's kind of like that small cap space that people just haven't been exposed to.
Right. So when I look at that and you say these are, they're very finite in terms of the amount that they can do, take me through, it brings up a really good point. There are a lot of options out there, but are they all given? I mean, are all options the same? So if someone says, hey, I'm going to do one of these drilling deals, are they all going to have the same results? I mean, obviously from a tax standpoint, yes, but from a total return standpoint.
Right. Every fund that has a deduction, a drilling fund will give you a tax benefit. But you really want to look at, and what the back offices and the due diligence community spends a lot of time with is, show me the economics first, and then let's back in the tax benefit. So what we try to do is couple those two together, right? We want to take the best economics, not just the highest return profiles, but the most predictable, right? Can we hedge? And yes, we do a significant amount of hedging for downside risk for our investor partners. Can we take out and strip out some of that economic concern? And can we marry that up, right, with the most powerful tax benefits that exist today? Right. And so that's when I said before, we'll offer, and our peers will offer a 20, 30, sometimes a 70% upfront deduction year one, as far as a write-off. We offer the highest allowable by law, which is typically 90 or a little over, so that investors can kind of stack their tax planning deck, so to speak, in that first year. But back to your point, yes, you're really looking at the economics first, the tax piece second. If these are structured correctly, the taxes are just the cherry on top and the sprinkles to the sundae. And that's really what we feel we've put together the last several years.
That's awesome. So when I look at something like this, and you're saying I want to look at like kind of the business side of it, someone's dipping their toe in the water saying, how do I even, what am I looking at? Like I'm getting a tax benefit from these intangible drilling costs. How do I do the economics to make sure this is actually a good investment?
The first thing you want to look at is that sponsor's history, not what I say I'm going to do. What am I doing? What have I done? Right? What's my track record on delivering on those? Because you and I can start a new COEX today, Eric, and have a big upfront deduction and say we're going to hit all of these metrics. But the reality is that you want to look at what historically they're on track to do, and does that line up to what they're telling you? Right. So what does that mean? For us, we're looking for very fast, very heavy cash flows over and above those tax benefits, right? Where investors can see a significant payout in a handful of years without the benefit of the tax that they get day one. Right. And so that's really for us, it's more about giving that pace of capital back to them quickly, because really this is an important part to understand. Within the confines or construct of a drilling fund, these are really designed to do two things: help with current year tax situations and become a cash flow tool. That's it. They are cash flow tools and tax planning tools. And there's a lot of reasons for this, but it's an important part for investors to understand, because after they get those big deductions, they're going to have very heavy, very quick cash flows coming back to their portfolio. And obviously that's where you come in, right, to help them do the planning and reinvest. But that's an important part that I don't think most people understand when it comes to the structure of these kinds of funds, because they are a little bit different.
Gotcha. So take me through, like, and obviously past performance, it is no guarantee of future success, but historically, what have people come to expect? Let's just talk about your funds, not industry wide, unless you know industry wide. From a cash flow perspective, you're going to get your deduction, that 90 whatever percent deduction, and then cash flow wise, what does it look like after that?
Yeah, it could vary, but it's not uncommon to see some cash flows be in the 30, 40, sometimes close to 50% range in the first 12 to 18 months, right? And it continues for years, sometimes decades, right? But it will start very heavy, very quickly.
What about the total cash flow return? Someone puts in, $100,000. What kind of cash flow would they look to get, and over what period of time?
Sure. Yeah. And over the life of any offering, and it depends too, if are they hedging, right? Because if you're going in naked, then you don't have that downside protection, right? So we hedge, right, to take some of that away. But over time, over the lifespan of that portfolio, they should be getting anywhere between 1.5 times their investment up to 2 times their investment potentially, with the life of the program yet behind it, in terms of cash on cash return profiles. This is separate from the tax benefits, right? But that's part of what we target for these assets, right? Which might surprise some people, right? Because we get this a lot. Well, you're in the oil sector. I was expecting to maybe get a 10-to-1 return. We don't take enough risk to come anywhere near those return profiles. Again, we're looking in our capital base, 30,000 investors, $3 billion that we've syndicated and put to work. They're looking for middle of the fairway. They want to wash, rinse, repeat. The same results. Yes, oil's 70, oil's 68, oil's 86. Who cares? If you hedge out the downside, that takes some of that risk away. We're just looking for those repeatable results over time that we can deliver for our partners.
Right. So just to reiterate, no guarantee of future, returns with what you're talking about, but you do have a high focus on repeatable results, which I like that. I like that phrase because it's something that, people tend to use once they get a taste of doing it. They tend to use it year over year because they do stack. To your point, they do give, that cash flow that's repeatable, and then they can also, continue to almost pay for itself over a course of time. I want to talk through one more thing. So again, like if someone hasn't ever heard of this before, and maybe their CPA hasn't heard of it before, what's the best way to get somebody comfortable with or educated on this? I mean, obviously we're talking about this in 15 minutes, but if somebody wanted to do a little more due diligence, what could they do?
First of all, they can contact yourself and we can put them in contact with the right parameters and the right discussion points that they're looking for. But there's several different deliverables on that point. We actually have a dedicated tax handbook that's designed for CPAs, has all the citations within it. It has the tax code where everything that we're talking about is literally within the tax code. There's a book that has all of that packaged together for them. And there's some fund specific materials if they want a closer look at the assets that are in the fund or historical performance figures. There's all kinds of decks that are out there and available that you can get out to those people. But I think it starts with what are they looking for initially. So we try to separate the two, right? Tax from the investment, the economic perspective, and they can kind of look at that through two different lenses.
Gotcha. And then once they start to feel a little more comfortable, look at it and they decide, hey, I want to do this. There are limitations on what people can do. I think you have a very unique process that we collaboratively do together. But what's that process to kind of dial in, the proper amount and maybe even the max amount that someone can do?
Yeah, there's a few different ways you can look at that. We have some calculators on our website that you can play with, and you can plug in numbers, your own figures, and it'll give you some of that data back. But to get more comprehensive, we also utilize a third-party CPA service that will take your exact information, right? So Eric Flago out of South Carolina, and here's his income, type of income, and deductions. And we can put it all out there and say, hey, for 2023, if you hit this number, this is your income that you said, this is your tax bill, because we're just applying tax law to it, right? So before it's too late, we can then go and say, well, if this is your tax bill, Eric, if you were to invest, say, A, B, or C, this is what A does to your tax bill. C, because all of these are above the line deductions. When it comes time to do your tax, which means you have other deductions going on, it does not interfere, does not reduce them, but it allows you to deduct above that line. So you can use that, a third-party CPA firm that we have that will run a hypothetical for you to see that net impact before you commit.
Right. To be clear with people as well, like this is something that I personally have done myself. I've used this service. I dialed in the number and it is very helpful. And this works in tandem with the CPA that you currently have. Like this isn't taking the place of anybody, but it validated, what the number, it crunched the numbers, and then my CPA could look at it and validate, all the work to say this is the proper amount. And it did what it was supposed to do. It got me a nice deduction, and we did get some income on it as well, which has been great. Before we go, Fred, I wanted to just ask one more question. The ability for people to do this, and I know the oil market is like cyclical. You did mention hedging. Not every place hedges. I think it's important for people to just understand the impact of hedging, just from the standpoint of why you do it and the goal of it.
Sure. So ultimately, right, beyond just take the tax benefits, put them on the shelf, right? Really what we're looking for in any well-designed portfolio, energy, stocks, you name it. If you could have participation in an up market and protection in the down at the same time, would you want that? Right? Now, and some people might say no, right? And in fact, I will be frank with you. We lose business. We literally lose business because people want more of the upside than we might be able to deliver because we're hedging, right? So when we're hedging and through various financial instruments, we're protecting that first 1x or that return of capital back to investors over a significant period of time on the downside. But it does limit our upside. So by hedging, right, it's like having an insurance policy We all like the idea of insurance, but what do we hate about insurance? We You don't want that. You don't pay the premium. So we're actually paying a premium with that hedging. So in other words, if oil at 70, 75 becomes 85, becomes you name it, right? We'll probably deliver less economic return than the next guy because he's fully naked in the market, right? So it's important to understand both sides to that, but it just comes back to what our capital base over time has demanded from us was, yes, clear above board tax benefits, predictability. One, two, one, two. There is no three. And so with that, that's why we do it, is so that we have that predictability, so that we have that for investors, that they can still get a significant part of the upside, right, in that market to participate on the up, but they want that downside protection. That's why we do that with our funds.
Absolutely. Actually, and you just reminded me of one last question. Timing. I'm putting money into these things. I know at the end of every year, I'm just going to somewhat softball this, but I know at the end of every year, everybody gets they get their numbers, they figure out what's going on, and then there's a rush to the door, mid-December. What's the best time to really start dialing some of these numbers in so you don't get blocked out?
Well, there's a couple of things. So one, I would say now, and there's a couple of reasons for that. The last couple of years, we have been overfunded. We will be oversubscribed probably quite early this year. Demand has outstripped supply on the inventory side from our perspective very early, or the signs are very early already. So we do have inventory out as of now, June 1st today. We also have an early investor incentive that's active until July 1st, so exactly a month out. And there's several different components that are basically better term deals, or better terms for investors in terms of the preferred return, and they're making interest on their dollars, and all kinds of other things. So I would say the sooner the better, not only because of what you're concerned about on the tax side, but I don't know that come December 1st, I'm going to have inventory available. I know that I was almost sold out last year and the year before. So with that said, the sooner the better for them to at least start to gauge what their needs are for 2023.
Super. Well, I appreciate you, Fred. Thanks for giving us the overview. For everybody watching, there's going to be some white papers and some links below to just kind of go through what exactly these things are, some points in the tax code and whatnot, to just give you some more flavor if you'd like to dig in a little more. But thank you again, Fred, for your time, and look forward to talking to you soon.
The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.